Dude, I completely forgot the last night you said I'm gonna probably start the stream at like 7 to 8. Guess who was up at 6:30? Looking like John Travolta. Like, where is everyone?
Good grief. Yeah, I figured I'd get a little more sleep this morning instead of just waking up at like 6 again. Orb number 11. Moving up in the world. Kind of gives you an idea of how much. Of course, you can make things a little bit quicker when you're by yourself, but just an idea of screen time to create, just one simple strategy. It can take a lot of screen time. Went ahead and shared the stream link in the recorded sessions and general chat. Give it a minute and see who else hops on.
I will jump on the YouTube thing. I'm just making coffee at the moment.
I got you. So we kind of skipped way ahead yesterday. You see the live stream right now shows an optimization curve. We are not at that point yet, but we were just kind of off topic last night. So I'm gonna go ahead and switch this back to our back test. 3.5 for. Go ahead and run that. And there's our basket for our mini baseline. So, what we're going to be looking at real quick is the slope idea that the rock had. Keep on calling him the rock, I'm not sure why. I like to think Dwayne "The Rock" Johnson is part of this group. But we just got the normal rock, I guess. We didn't find the, I guess, exact kind of indicator. To measure the slope of the VWAP. One second, I'm trying to pull this chart up and talk at the same time. And I haven't pulled this indicator up on the chart yet, but I do think it's going to do the job. I can recall what it was called. Slope enhanced. Cool. So it's a neat little oscillator that tells us the slope, and the slope can typically be used to measure momentum. You can see, here the slope is very big. We had a momentous move, so slope is very lagging. But it's good at telling us that we did have a momentous move, or whenever we did have an area of consolidation. Due to the lagging nature, of course, we're not going to be using this on the time frame that we're trading on. That wouldn't give much value. However, we can look to we're going to use it on a higher time frame and see if maybe the slope of like the weekly or the monthly would predicts anything for future opening range breakouts. And even use orb for slope for divergence. Like I was telling y'all before, you can find divergence in almost any indicator. You see we have a higher high here on price, and we have a lower low on the slope, or a lower high on the slope. So pretty cool stuff. So it gives see if it's normalized by default. So normalize it by the ATR. It should give us more consistent values against other products when we're using, because since we're using the actual slope and not just if the values are greater than previous value, we do need.
Can I get some context? Can I get some context? Because I don't know exactly what's going on. So, are we looking to predict the breakout?
Yes, we're going to see if the slope of a line on a higher time frame helps as a filter any for our opening range breakout. So basically,
Okay.
is the slope on the monthly chart, up a certain amount? And if it is, take the next opening range breakout. We're going to see if that is a good filter or not. And so, since we're using the actual slope values, it needs to be normalized for us to use it across multiple products. And so, for example, let's see, like we can see over here at 0.2 is considered, pretty good slope. We can see the price action, pretty good slope. Whereas, 0.4 is just a mega slope, very steep. And so if we go to a different instrument, we kind of want to see the same thing just to confirm that it is normalized across different products. So let's go ahead and just add, let's look at the NQ. And you can see course, these are very correlated, and you can now see how correlated they actually are. But here we are at the same time of price action, and 0.2 is still the value for this type of move. So that confirms that it is normalized, and that whatever value that we use will, translate to other products. Which is cool, actually. I've never dealt with a normalized slope value. None of my strategies use slope. And a lot of times you need to make sure that your indicators are normalized in order, if you start using stuff like thresholds, like, volatility is a perfect example. Volatility needs to be greater than whatever. I was telling gold the ATR is in ticks and points depending on what kind of ATR you have, but it's not normalized. You would need a ATR percent, which they do have. It's nothing groundbreaking. It's nothing new, but just like, for example, if the ATR and the NQ is 20 ticks right now, and the ATR on the ES is 10 ticks, and that doesn't tell us which one has higher volatility right now. That just tells us the amount of ticks on each instrument. Whereas if we had an ATR percentage, we could actually compare the volatility. Like the volatility right now on ES is 40%. The NQ right now is 20%. You can look more into that on Google. On normalized volatility. But cool. So let's go ahead and add this filter to our strategy. Now obviously we're going to take away our EMA filter because we want to see if this filter does better than the other filter. I'm not going to stack filters. That's usually never, it's extremely unlikely that you'll get better results by stacking filters. So let's go to indicator, and let's go to the slope. Now I haven't used this indicator before. Actually, that brings up something else, because the actually I shouldn't need to just use the direction. I think this indicator outputs a number for whether essentially the color of the bar. So if you didn't care about the actual slope values and you just wanted to be like, okay, slope is up or slope is down, then for this indicator it outputs I think it's 0 or no, it's greater than 0, but even still, that's because it's an oscillator. But it's, if you didn't care about the slope and just care about the green line or the red line, greater than 0, less than 0. So back to the indicator. Seems like Rock is having an issue. Load it. Where'd you send that at? Oh, you're having trouble?
Hey, no, I'm the super trend one that Ray Gun sent over. I'm having trouble loading, not the slow one. It's like giving me a weird error message, but I don't want to get us off topic.
Yeah, if you continue to have issues, we'll definitely look into it. I'm not sure why. Might be having issues with that. Looks like I might need to restart Ninja soon. So let's go down to our slope. We're not going to plot it because we're using it on a higher time frame. Has different MA types that we'll definitely experiment with. As like I was telling Rock, if someone could add the VWAP as an input type on here, I don't think it'd be too hard to see how the formula is put in for these and just kind of add the VWAP. I'm just going to use the SMA for right now. Normalization type. Love how it gives multiple options, but we're just going to keep it to the ATR because it doesn't really matter what the normalization is, just as long as it is normalized. And we're going to start off with greater than 0.2. And we're going to start off with the daily chart. So price close. So we're looking to see if we got a nice slope on the daily chart. And if we do, that's going to give us a thumbs up for taking our orb. Right now we're, basically saying we can't just be up, we got to be up quite a bit. So that might be adding too much of a constraint, but we're going to find out. Now this filter period isn't doing anything here. Just keep that in mind because we've removed the indicator that was using this parameter. Let's go ahead and run it. So only got 108 trades total. So very, very over filtering. We can move it down to 0.1. That should give us some more trades. Gave us some more trades, but still very over filtering. And we'll just say greater than 0. So we're just going up in any way at all. Just the slope is up. Just go ahead and run it. Still no good. How about the opposite? What if the slope is down? Let's do 0.2. I got to negative 0.2. Make sure to put that negative in there. Yeah, it's less than negative 0.2. That is some really crazy results, actually. Sample size is way too small, but definitely appears to dramatically increase the quality of our setup. Let's look at the that's hour of day. Let's look at trades, cumulative net profit. So very seems like better performance when the slope is down on the daily chart, which kind of plays into our original premise with, the basically have to be going down on the higher time frame before taking the orb. So before I move forward, I just want to see this against the baseline, see if it actually improves the baseline or if this is, basically just random chance due to the small sample size. So let us go to the core basket. Make sure it's correct. We did see improvement like this before using a similar premise, but once we ran it on the whole basket, it proved to just be over filtering. So that's going to take a second. So it already was starting to freeze up on me, so I might need to restart it. But maybe we'll be able to run this test. Just kind of checking out the slope indicator a little more.
In like the most basic, to explain to a 5-year-old kind of way, how does the slope like calculated? Is it just looking at like the distance between highs and lows and compared to each other, or is it like price over time, or?
Like, are you asking for like the formula for slope?
No, not the formula. Just how does it look at it? Like how does it read it, kind of thing? Like in the most basic way.
Well, I don't fully understand your question, but like the easiest way to, think about slope is just, if it's steep or if it's not steep or if it's, if it's flat. And so if the slope is high, that means that we're just moving up very efficiently, basically.
Okay, so it's not necessarily like the angle of the move, or it is, or.
Well, since we're looking at a smoothed price, we're looking at the slope of the SMA. So this oscillator doesn't actually show the SMA on the chart.
Okay. It's not price. It's a smooth line of price.
Yeah, exactly. So we're just looking at
Got it. Okay,
the
that
SMA,
makes more sense. I was like,
which,
is it taking the highs and the lows? It's just the SMA. Okay, that makes sense.
yeah, you can see here it uses the 14 period SMA. So if I actually put the SMA on the chart, we can get a visual. 14 period is, the default. But you can see here in the SMA, the slope is going to basically follow, really steep here, and it kind of levels off a little bit right here, and it's constantly tracking the slope until, we're a little bit
Yeah,
negative
this
here.
this this makes way more sense now. Sorry, I couldn't even think how this is working
Yeah, I got
at
you.
all. Yeah, it makes sense now. Cool.
I want to see how the D trend box affects it. So honestly, I don't remember what D trend does. See how the slope of linear regression.
The trend shows the trend. I'm sorry. I'll be quiet now.
Say it again. What are you saying?
I was trying to make a joke saying D trend shows the trend, but I'm deliriously tired. I'll be quiet now.
So it's linear. The slope of linear regression is a lot smoother. Here's another example of some divergence using the linear regression, where we have this very consistent move down on the linear regression, and taking higher highs. Basically, this is a much move higher than this move, but we're much less slope. Yeah, I might try out the linear regression as well. Pretty cool indicator. Right now we're using the daily charts, so we can just check out the slope on the daily chart and see if this is actually helping. Because remember, basically these big green bars are going to be when the opening range breakout did a good job. So we can see right now we're using negative. You can actually try to just highlight. So this is our negative zone where we're taking some orbs. Whereas we're in the green, we're not taking any orbs over here. So you can pretty much see right off the bat that more than likely the result we got from the other test, you know, it's going to be too over filtering. But there is a possibility that it improves just the quality of our setup. That's why that's my dog making a weird ass sound. But so we already know we're gonna have much less profit. But I'm gonna be looking at the other metrics, you know, mainly our drawdown to profit ratio using this filter. I just maximize my screen. Give me a second. It is slowly trying to complete the test. And you can see when we're negative here again, we would have been taking opening range breakouts, all of this region. However, we are using negative, has to be greater than -2, so actually let me refrain what I said. Let's put a line, horizontal line at the -2 mark. I have to give it a second because it's trying to run this test, so it's freaking out. Yeah, same premise as oversold indicator. Which of course we tried the other way at first, you know, just using the upward slope. Basically like a hard upward slope, a casual upward slope, and then just upward slope period. Those didn't do too well. I don't think using the downward slope is going to help either because we already used RSI. And the RSI gave very similar results when we used the 2-period RSI when it was oversold on the daily chart. It gave really good results on our mini basket, but then whenever we went over to the main basket, it didn't do so well. Probably should have restarted before trying to run this test. Didn't you, Rock, talk about maybe seeing if like the slope was basically flat, like pre-market?
Yeah, I was talking about slope on VWAP. I mean, it's similar to what is it? Is that whatever in terms of just cycles in the market theory that trends are always going to be followed by a base of consolidation beforehand. So you could basically
I see
you
what
could
you're
use
saying.
any type of moving average for that, but what I found the
Well,
market doesn't move in a exact V-shaped pattern all the time. It moves in consolidation and then it's going to trend base.
yeah, I see what you're saying. We didn't use the pre-market price action, but if you recall, we looked at the relative range and we explored basically, since we have to wait 30 minutes before a trade, we looked to see, if the opening range was tight, basically if it was, not much volatility, it was tight, whereas basically a moving average or something would pretty much stay flat. Kind of the same concept, just using the opening range. The first 30 minutes of the day, if the volatility is low, then you might get an explosion after, followed by that consolidating price action, basically.
Yeah, that makes sense. Basically the same thing. That makes sense.
We didn't improve results, but like I said, we haven't used pre-market price action yet, and maybe that might make a difference. If it ever comes out of this freeze. So I'm gonna have to go ahead and restart it. So let me go ahead and do that. Unfortunately. That issue popped up with someone else trying to use a different indicator. I don't recall which one it was. I looked up that arrow one day and it was didn't give much insight to what might be causing the issue. So before we test the baseline, let's just see if we get better results. I just want more sample size, period. So let me just see if this correlates if we just run the 2021 to 2022 just on the indexes. That way we'll get a quicker insight to if this filter is actually giving us any secret sauce. Or is it just tempting us for no reason? So, slope indicator is pretty cool. Kind of measures another way of measuring market efficiency, because the slope is only going to be this dramatic whenever the previous move was very efficient. And you can see here, it's a very efficient move. Whereas we could actually, quantify something like if the slope, you gotta put two lines. If the slope, where is 0.2? Let me make that 0.2. Looks like our test is done. I'll go back to it in a second. Why can't I freaking copy and paste a line? Negative 0.2. So we could say that if we fall back inside this range, that if price, if we stay within this range after a certain duration of time, it indicates that we might be due for a squeeze or a change in direction or just something along those lines. So like from here, from 12, so 1 to 1 minute chart, so 30 bars basically. So we'll just say 12 to 12:30. Okay, we've been inside this range for 30 minutes, so we'll take the breakout in whichever direction, but not the breakout on the chart, the breakout on the slope. So you see here, we broke out of this range where we take a short trade. So it's another little pattern concept, a lot of ways you can come up with patterns. Same thing happened here where we fell back into the range, waited at least 30 minutes, took the breakout following, you might find out that taking the breakout isn't as good as waiting for a pullback. So let us look at our results. So, it's still good. Let me run it without the filter. Or actually, I guess it's really not that good because it made our best performer negative. So yeah, it's pretty trash actually. So let's go back to the, I think that's a better way maybe of doing it just for speed purposes. So if we get, we have our modification, so it's like a 3-step validation. We do the last 2 quarters of 2022 for our initial testing modifications. Since indexes are already our best performers, we'll just validate it with the full sample period 21 through 22 on just the indexes. Then if it passes that test, then we'll do the core basket test to see if it's actually improving the robustness. Just to save time, to reduce the amount of times that we actually do the core test. So let's go, we are already here to the orb base. So let's do negative 0.1. I want to try to run through these really quick just to ease curiosity. Let's go ahead and add additional data. So let us add the month. So 1 month. Now let's move back. Let's add that. Make the input the monthly. 14. Everything looks right, and we're just going to say the slope is above 0.05. So just slightly upwards slope on the monthly charts. Yeah, I mean, it just doesn't even come close to beating our mini basket, our current mini basket results. Let's just do 0. So, oh, I did that wrong. It's supposed to be greater than 0.05. So the monthly slope is greater than 0.05. Now we got the old no results. Let's see what happened there. Well, looks like it's set up right. There's a monthly slope never greater than 0.05. Let's do greater than 0. Interesting. So what this is telling us is that for these 6 months, the slope was actually down, since we are on a monthly scale. And so this is just, I mean, right off the bat, a symptom of just way too much filtering, because now there's, you know, if the slope is down, if the value of the slope is down, then we're not going to take a trade for an entire month, because you have to wait for a whole another month to get a new value. So that is no bueno. Let us do a smaller time frame. Let us look at the 30 minutes. So going much more, let's do the hour. So we're going more intraday here. And we're going to say if the, if the slope is greater, you make sure we're still normalized. Slope is greater than 0.0. We'll do the extreme first. So 0.2. No good for the 0.2. So I'm sure you guys can probably just see a theme with using filters. We've been looking at filters for the past couple sessions, and they're all just pretty much doing the same stuff. Now for this type of setup, so since we're trading the same instruments every day, it's going to be difficult for a filter to improve our results. Whereas, if we were like trading stocks where we had like a scanner, yeah, that's what we're about to test now, just greater than 0. But like if we were doing stocks, then filters might come in a little more in handy. Let's looking at like the relative volume pre-market, which is actually something we haven't tested yet. We've looked at relative volume during the range, but not the relative volume during pre-market. So greater than 0 is no good. Let's just do less than 0. And we're still on the 1 hour charts. Yeah, I mean it's just the same concept, same results, just a slightly different fashion on all these tests for these filters. Slope is less than 0 on the 30 minutes. So it's going to look at the previous 30 minutes before the market open and see if that slope is down. It does not help us out. Let's say, okay, before the 30 minutes, let's, say the slope needs to be up. Let's do.
Oh, did you get those out of Israel?
Let's do a linear regression.
When I was fixing my computer, I needed one with working internet. So I was using these. I had the door open and I went in there and she was smashing the keyboard.
I'm gonna choose linear regression here.
But did you turn on the heater on back there? 'Cause last night.
Where are you going? Where are you going?
I'll put them on mute for now. So, linear regression slope is up. Let's see if linear regression gives us any better results. So linear regression does give us better results, but obviously it's not good enough. Is there even a point in testing the opposite? Probably not. Let's just do it. Okay, I think we have satisfied our curiosity with the old slope. And so, yeah, some like with most lagging indicators when we're looking at, those types of things, it just doesn't really give us much insight because the move's already happened, But even using the opposite, using it as a leading indicator, like saying, okay, when the slope is down, maybe we're due for an upward move, Still just too over filtering. But this is still a great indicator. Like I said, we could use it for a potential pattern for itself. You can identify. You don't always have to identify patterns just on price action. You could identify a pattern on an indicator and look to exploit that pattern. Because indicator just lets you see price in a slightly different way. So it can make you think of new ideas. You can see here is pretty interesting. Obviously we're in a nice long uptrend, but there's a lot of different ways you can quantify these patterns that are occurring here and experiment with different kinds. Of course, like within the 30 minutes, within the the range within 30 minutes is still an option. Break that range, wait for a pullback. Of course, you have divergence as well. Okie dokie then. So let me now think about how we can look at the pre-market action this like a squeeze concept. So I know a way we could do it. I don't think it merits the amount of time it would take. I mean, I just don't think it's gonna improve, to be honest. But you'd have to like create a variable with a time filter, and just look at only like the however many pre-market hours you want to look at, and then check to see if we're inside the range or less than 0.2. And then greater than negative 0.2, and set that variable to true. And if that variable stays true to our current long condition, then we take the trade. And then do another set where you look at if it breaks beyond the range, you set that variable to false. So if one of y'all want to test that out, maybe in your spare time next week or something, by all means. So, I think we can move on to a different topic, kind of move away from filters for now. Of course, we'll keep our current filter, which was price close on the 60 minutes. So basically the value of that close price is less than the EMA at the time of the breakout. Because I'm sure y'all want to actually improve the baseline. Haven't improved it in quite a while, but we have been giving some valiant efforts. So cool. We added our filter back. Let's make sure it is.
So at this point, do we really need to improve the baseline?
Well, of course we
At this
don't.
point,
But we can't leave ideas untested, or at least I can't.
yeah, I see.
Like that's just how I am. I like to constantly dig. And so let's move back to our announcements for a second. So, orb filtering. Can we actually predict an orb? It's like I was saying, I think if we were trading individual stocks, where we trade different stocks every day, then yes, I think we could give some filters that would predict an orb or highly increase the probability of it happening. We could simply look at, like the famous setup, the old gap and go. That's still a setup that works when we just gap up and we keep on going on stocks, or look at relative volume, and the relative volume is greater than like 500%. Typically there's like a catalyst, something fundamental that's causing the stock to do some crazy action, and we can look for gap and goes, opening range breakouts on specific stocks. But with indexes, with indexes and futures, that just isn't really a thing the way it is on individual stocks. Since these indexes are made up basically a ton of stocks, it's just not the same concept. And so our filters just aren't really going to beat random chance on predicting when an opening range breakout will occur. It doesn't mean that, filters and other types of setups, other types of patterns, for futures contracts won't benefit us, but it is certainly not benefiting us with this pattern. But luckily, it doesn't need to,
Yeah, since there is no gaps in indexes. So, do you think we should add more assets to the basket, or not the idea at all? What do you think?
Well, I mean, no, we've pretty much looking at as many contracts as we need to right now.
So, adding stocks and adding the filter is the way to go.
No, that's not what I'm saying. I'm just saying if we did create an opening range breakout for stocks, because I'm not going to be trading stocks. Like, if you guys want to trade stocks and maybe incorporate those ideas, by all means. I'm just giving y'all the full scope of things.
Okay.
But of course, in the future, we could still look into maybe, checking out other filters or something if someone has an idea. Because filters only work for prediction, because there is no there is no lagging filter that can predict something. It's the premise behind it and the concept doesn't make any sense. It doesn't work. That's why people say only go long when prices above the 200 EMA. It doesn't do anything. Just as good as going long beneath the 200 EMA. And we've proved that here with running all these basic filters, which honestly just gives bias, which is what something like a 200 EMA does. It's just giving you like a bias, but bias doesn't do anything. It doesn't help the pattern overall. The only thing that could actually help the pattern is something that predicts it, and we've tried a lot of different ways of predicting it.
Do you think that checking the number of losses, for example, before this trade will help? Like, if the opening range is not working on this asset for like past 2 trades or the past 3 trades, will this imply a better success rate, for example? Well, I tested this idea and on Forex back in the days, and I know that uh, it's it's going to improve the success rate as long as the idea is working. Like, if, for example, something is working in the past, it should
Yeah, so
continue work.
I know where you're going with that. You may be like, well, what if we add a filter and like our win percentage goes up? And that's possible, and that's more prevalent with like other types of patterns. But since the premise behind our opening range breakout is we get a breakout and price goes way in our favor, like the fat tails that we catch is what makes this pattern so good. And so we're not really concerned with like the exact win percentage for this pattern. Whereas like maybe like a more mean reverting pattern or a pattern that has like set targets, like a 1 to 2 or something like that, then filters might, give us a little more something to work with here. But because adding these filters, like, we don't know when a fat tail is going to occur, so that's why I said in previous posts that our filter has to also beat random chance. And the random chance being that on any opening range breakout, we can get a massive fat tail. And we don't know which one is going, or which opening range breakouts are going to give that fat tail. So not only would our filter have to, increase our win percentage, it also has to beat random chance. And it's very hard to beat random chance.
So you'd be way more comfortable running a filter on something like a mean reversion with a 1 to 2, but if you're running it on the fat tail thing, it's literally any trade could be like what you said with the chance thing. It could be a fat till.
Yes.
But if it's not, if you're doing it on like a mean reversion with a 1 to 2, even if you do filter a winning trade, it's not bringing you to a new equity high. It's just one cog in the machine kind of thing.
Exactly.
Yeah,
And
that
that's
makes sense.
and that's kind of why Joe touched on that a couple of sessions ago. He was like, basically saying the same thing, that for other types of strategies, filtering is very useful. But based on the premise of this pattern, you know, it's not. That's why this is a great core pattern, like for I said, for a portfolio, because whenever it works, it's going to make new equity highs. And so now it's kind of based on adding other types of strategies to just offset, stabilize the equity curve whenever opening range breakout isn't happening very often. So we've talked about predicting the orb. Now we can move on to trade management again. Something we haven't looked at yet is we've ran a lot of variations of how to manage our trade. Now what we're going to look at is, what about intra trade? What should we do with our stop loss? And the first thing I want to experiment with here is.
By the way, Akotic, I have a question.
Yeah.
Like on the set 4, right now I'm on the set 4, and I'm trying to recreate the strategy. And I see on the third condition, you have bar since entry execution, like the third condition on the set 4. Can you check that? Like
Yeah, bar since entry. I'm pulling up. It's up on the chart now. Bar since entry is greater than 10.
Yeah, so bar. Okay, I see. So once we have 10 bars, we exit, we scale out. Right? We set the scale out variable to true. Then once the variable is set to true, we do what next?
I can I don't want to get too far into that right now. Maybe towards the end of the video, I'll go over all the conditions again.
Yeah, okay.
And I'll pull them all up so that
Yeah.
people can, since this is the last session for like a week, they can watch the end of this video and see the current conditions. They want to build it over the next week and go from there.
Okay, thank you.
Yeah, for sure. So I just want to explore a little bit more trade management, because right now, we have our breakout, and then remember there's two potential outcomes. There is price moves in our favor, or price messes around in the opening range. And then we have first kind of a delay, which is 10 bars. So we have a 10 bar delay, and then we look to see, are we in the negative or are we in the positive? If we're in the negative, we have a scale out condition, so we put a limit order at our break even in case price comes up, kind of takes us out some. And then we have if we're in the positive, we had a condition where we add to our trade. And our initial stop is if the Laguerre, which we're using as a little bit of lag, crosses below the midline, which it might do over here at some point. So cool. Now what I want to experiment with is, if we add to our position, we already know that the 10 period low needs to be greater than the opening range high. So the 10 period low, looks something like this, if price is in our favor. So we'll just say that it's moving up, and then maybe it breaks the 10 period low right there. So this would be our add. And so what I want to experiment with is once we add and the Laguerre is greater than opening range high, that we move our initial stop from when the Laguerre crosses beneath the midline to when the Laguerre crosses the opening range high. So cool. Let us do that real quick and see what happens. Let me think for a second. So whenever we add, because remember we start our trade off with 2, and then after 10 bars, where is it at? Here it is. So after 10 bars, we set our add money to true. If it's true, 10 period low less than previous period low, we enter long. So that gives us an easy condition to work with. Because now all we have to do is add a new condition and say, okay, current market position equals long, and our position quantity, current position size, equals 3. Now we gotta pull up the Laguerre. So where is the Laguerre? Let me just copy and paste. And now we're gonna also check to see if the adaptive Laguerre is greater than our opening range high. So let's see, we're long, position quantity is 3, and the Laguerre is greater than our opening range high. So I'm trying to think if I need to add a variable. So I wasn't wanting to add another variable, I might need to. Yep, have to. So we're gonna call this variable we will call it stop change to just try to make sense. Set it to false by default. So when this happens, we're long, position quantity is 3, meaning that we added to a winner. This only happens when we add to the winner. And then Laguerre is greater than the opening range high. We're going to set this variable to true. Now we have to add another set and say, okay, stop change equals true. Let's copy and paste that Laguerre. Stop change equals true. Now adaptive Laguerre crosses below not the midline, but the opening range high. So if stop change is true, meaning we added to our winner, you know, everything is looking good over here. Now, while it's true, if we cross below the high, we are going to exit long for our entire position, so current position size. And that's it. One more thing, the stop change needs to be changed back to false. So position on our set number 6, position equals flat. Let us add set stop change to false.
So this moves the stop if the Laguerre is above the high, and if you've got 3 contracts. Only under those conditions it moves the stop to where it only under those conditions it creates a new condition where it will exit if the Laguerre goes back below the high. Is that correct?
Correct.
Okay.
So essentially, we're saying
I don't understand the false true things fully yet, like what you did at the end. I don't know why yet, but I get the logic of what we're doing.
yeah, it's very simple logic behind it. It's just we add to our winner. Let's move our stop up some. That's all we're doing. When it comes to quantifying that, it can seem a little bit more confusing, but the premise is extremely simple. So let's go
I think
ahead.
we will have probably a higher success rate because we will exit sooner than.
Well, what we're worried about here is the noise levels, because if we add to our trade, now we are at greater risk for getting stopped out like prematurely if price comes down and does this and keeps on going back up. So we might miss out on some fat tails by adding this rule because it's more strict, but we don't know. So we're about to find out.
Quick question on the rule thing. This is separate to if price is out of the money after 10 bars, that's still like turned on, right?
Correct. That's separate.
This just activates if after 10 bars we are in the money.
Not at that point. That's why I said the quantity has to be 3. So if we're in the money and then we add to our position and the Laguerre is greater than the high, then we change our stop.
Okay. Could we have a situation where we add to it and the Laguerre is not above the high? Is that possible?
Correct. In that case,
okay.
It'll wait until the Laguerre is above the high and then move the stop.
Yeah, so once all conditions are met, then it'll create the condition where it exits if it goes back, the Laguerre goes back below the high. Is that correct?
Yes.
So it's just like switches and downstream, upstream kind of conditions, I guess.
Yeah. So let's go and test this out real quick, and let's see, let's make sure it's doing it, it's operating correctly on the chart. And so we got less profit and less drawdown. Let's make sure, let's try to find a scenario where this is occurring. Because I think that, the only thing that's going to really make us give worse metrics here is what I just stated, is whenever price, and we add to our position, and then price comes down, and then originally, we didn't get stopped out because it didn't go down far enough to make the Laguerre cross below the midline. And then keep on going back up. So that happening too often is what's going to give us worse results. Let's find an example.
Laguerre, by the way, is an HER that is smoothed.
No. The smooth ATR is our trailing stop.
What's the role of Laguerre? Is it a smoothing method? No, that Laguerre is a smoothing method.
Yeah, the Laguerre is just acting as a slight lag to avoid
the price.
To avoid some noise.
So it's Laguerre of the price.
No, so you can think of the Laguerre as just a moving average. It's just a moving
Yeah,
average
but
of price.
of price, okay. That's I just want to know the input. Is it price or something? Okay, price. Okay.
Yes, yes, price. Um, let's see what's going on here. Take some off. Added some more here. So I'm trying to find a scenario where it actually doesn't work in our favor. Okay, so here's an example finally. In this case, it did do what we wanted it to do because it didn't, move back in our favor. But so here we added to our position, and then when the Laguerre crossed the midline, or when it crossed the upper line, it got us out. Now, a way we're actually losing more money here than usual is that we would have actually held this trade until down here, but because this occurred, we got a new position when this happened. So that's two potential pitfalls of this addition. So anyways, done with that. So let's go ahead and remove the this new rule. So we had two.
Are you like done? Like it's no good. Like next, move on, kind of thing, or
Yeah, exactly.
okay.
Because this is just executing the premise of, let's move our stop higher once we add to our position. Well, it turns out moving our stop higher once we add to our position doesn't help with this pattern. So that's all we needed to know. So I have something else that revolves around trade management that we're going to look at next that I think is really important to the bottom line. So let's go ahead and run this test to make sure we're back to our baseline. And we're back to our baseline. So, try to premise out. It was no bueno. Now we have something else we have to look at. So, as we know, our current exit is when the Laguerre crosses beneath the midline, in which case we would exit our trade. But this leaves us susceptible to price shocks. Price shocks are those omega red candles from hell that just never stop going, right? So what we're going to do is we're going to leave this lag for the midline, but we're going to have a hard stop at the opening range low. So you can think of this as like our normal stop loss, but the opening range low is going to be like our ultimate, like hard maximum stop to prevent us from ever a price shock occurs and price tanks 1,000 points in one bar. Since right now we're just operating on bar close, it would make us wait till the bar closes, which can cause
Like worst case backup stop.
Yeah.
Fail safe.
So this might, reduce some outliers, or it might just happen so rarely that it's not worth adding the rule. So let's go ahead and add that real quick. So it should be, off the top of my head, it should be pretty simple. We're just going to say strategy, current market position equals long. Gotta add a variable. We're gonna call it just stop price. I'm going to make it a double stop price. There it is. Back to conditions. So we're gonna add, whenever we're long, we're gonna set our stop price to the opening range low. And then in another order management, we have to now say exit long position by a stop order. Set the stop price to the variable stop price. And so we have to have it on the position equals long because these, for the strategy analyzer and the way these run, it refreshes every bar. So after every bar, it looks to see if the condition is true. And so every bar it's going to say, okay, we're still long. So let's keep this order here. So it's cool. We just needed to add one set, and this should do the trick. Let's go ahead and add it and see if, okay, so before I run it, this is a perfect example of all the possible scenarios. As you can see here, price came all the way back down and just barely touched that opening range low, which would have stopped us out. But we actually got a more advantageous price for our exit. And so that's why it's important to think of both scenarios and how they're going to offset each other. Because yeah, there's going to be times, it's going to be 1,000 times when price closes too low and gets you out at a lower price. But there's also going to be 1,000 times when price retraces some and gets us out at a better price. So you can't just think about the potential worst outcomes. But we're going to find out if using a hard stop for the opening range low, is better to the bottom line. Ideally, decrease. Oh, okay, something's wrong. So don't get too excited yet. We are only scaling out of this in this scenario because I forgot to set it to our current position size. But that is an interesting premise though, that maybe at the opening range low, we just take off some size. Let me actually see real quick. Yeah, because the Laguerre. Okay. So yeah, let's just change it to position quantity and see how that affects.
I got a suggestion for you.
What am I looking at? Oh, okay.
So if you look at the set stop loss versus set stop exit long stop market, if you use set stop loss at the point where you enter, it will stay active even if like Ninja Trader crashes and you don't refresh it every bar. Because I think it submits it to the market. I mean, if that's what you're doing, if you're setting the hard stop to the opening range low when you enter anyways, it might be more secure
well,
to do it that way.
We technically are. The thing is, if I set this stop over on my first condition whenever I enter long, it won't execute because that's a common issue you'll find with the builder a lot if you set it when it actually occurs. Because after one bar passes and we're long, the limit order will no longer be there. Whereas in
Oh, not
this,
the limit. Just set stop loss. It's not the limit order. Does that make sense?
under order management, I mean, there's only two options here. You have the stop order and the stop limit order. The exit long, let's see.
There's no set stop loss under order management. Go down.
No, there isn't.
Oh, okay. I guess that's the difference in the builder and the just coding it.
Perhaps. You know, the builder has a different section that has stops and targets, which is probably what you're
That's probably
referring to.
Yeah.
But we can't set variables in this part of the builder. So that's why we have to check every bar that we're long for it to actually stay there. So maybe we'll look out and get better results by setting it to our current position size instead of it just scaling out some. But it looks like this might give better results, which is kind of exciting. But it makes sense because it can potentially avoid some of those price shocks. Unbelievable. So cool. We do have better results on, it's kind of significant as well. Let's pull up our current mini basket baseline for comparison here. And I want to look at each individual product first, real quick. Go, let me.
Yeah.
So for RTY, we have more profit, less drawdown, higher profit factor. YM, we have more profit, less drawdown, higher profit factor. ES, more profit, less drawdown, higher profit factor. NQ, I mean, it's across the board. So, and all it's doing is preventing us from taking those giant losses on those red candles. So, really cool. Before I go test it on the main basket, what were you gonna say, Gold?
I just wanted to make sure I understood it, and it's you just explained that it's literally just capping the, because it's capping the crazy like price shocks, like the crazy red candles. But
Yeah.
is this how this is working? Is this because the Liger will get you out, but is this when it's just so far too quick for the Liger?
Yes.
In a way, like, is that what's happening? It's just like a
So,
hard price. Like,
it's like let me do the illustration again. So it's like if price,
because the Liger will get you out at midline, but if it's
yeah,
like 20 points below the low, then it's going to be a delay, and it's nowhere near the midline price. Is that like the hard stop is at the low that kills it dead, right?
yeah. Now you can see here
Okay.
on the real chart that the Laguerre crossed the midline the same time that price hit the opening range low. So there's going to be
Yeah.
scenarios like that over a large sample size where, you know, price will just kind of mess around here really slowly, like on normal days, and the Laguerre will just kind of casually cross over and then get us out.
At a sensible price.
Yeah, but then there's going to be days when we're just kind of hanging out and price is like, goodbye.
Yeah.
So
So basically, we designed the system with a soft stop that basically takes volatility into account instead of prices, and then a hard stop to basically say, here's your emergency exit, and that seems to improve things overall.
yeah, sure.
That seems like a pretty universal principle I've seen in my testing as well.
For sure. I think I call it like the ultimate stop. Like we can have things as like, because you hear me say in the past that like keeping things as dynamic as possible, allowing the market to, account for volatility and noise and all that good stuff, and that's really important But then I think it's also important to have an ultimate stop loss, like a stop loss that just completely invalidates. That basically, if price reaches that point, it just completely invalidates the pattern that you're trying to exploit. And if we're trying to trade an opening range breakout, then obviously the price that would just completely invalidate the setup is if price is now at the opening range low. That's why we're using it as our ultimate stop. But
Can I ask a question about when we first started this? Because we test at the beginning. We tested stop on the low, and that.
Yeah. So that was just like a general initial stop. So like, I mean, yeah, if we have our stop at that for every single trade, then it's no good. But then it's also not shielding us against price shocks. Because all we're doing right here is shielding against those giant red candles. But on normal...
Did it not give us good results before? Is that why it wasn't included up till now? Or I'm trying to understand.
Well, basically,
why we didn't use it.
Using our initial... Yeah, it didn't give us better stops. It was basically saying that using that as our initial stop... Or actually, let me correct myself. It was the best stop loss, but not until we added basically after we added the Laguerre filter, since now there's lag, the midline became our best stop, only with the lag involved. But without the lag, the stop at the bottom of the range still gives us our best results.
And now we've got both instead of one or the other.
Essentially. But so, I mean, yeah.
Was it not tested before with both? Or I'm just trying to understand how this works with the process and stuff.
I think the best way to understand it is to see that, like, this is only shielding us against outliers whenever
Can I ask it in a really, really basic way that it's not supposed to be cheeky or anything, but how come we didn't do this before?
Testing like an ultimate stop?
Yeah, like, because we had it on the low, but then we changed to the Laguerre on the midline, but did we either or it, or we didn't ever test both together? Because that's what we've got now is both, or am I missing something here?
We tested the Laguerre on the lower line as well. You can't really test like both, so to speak, because you can't say like, okay, we'll exit when the Laguerre crosses beneath the midline, and we'll exit when the Laguerre crosses beneath the low line, because
it'll hit the midline first.
Yeah. So like that's why it's separate. It's just like a separate hard stop, and it's not a condition. It's not a crossover. It's just an actual price that we're placing a stop loss at as our ultimate stop.
Okay. We never did that at the beginning, or
no. Before we was keeping everything. Before we was keeping everything as dynamic as possible. But
okay, that's the piece of information I'm missing. I'm like, because I thought that's the first thing we did is we just put a stop at the low, but it wasn't a hard stop, is what you're saying.
Actually, not. No, it was a crossover. It was a cross below the low.
Okay, that's the piece of information that was missing. I'm like, I thought we tested this right at the beginning. How are we rediscovering this now? Like, I didn't get it, but because it wasn't just a straight up normal stop.
And so, like,
okay, all good.
And even though it was a cross below the below, even though it was a cross below the low, it still gave us the best results. But I still want to end up testing, what if we just place a hard stop there? Because keeping things as dynamic as possible, like I said, great. Normally really helps the bottom line. But we do need to have like an ultimate stop loss that gets us out. And I mean, in any strategy, and it just needs to be the price point that invalidates the pattern, since we are trading patterns.
My bad. I thought we had tested this right at the beginning, and we're redoing it now, and I got really confused for a second. But I didn't realize it was a crossover and not a hard. I thought it was a hard stop at the beginning. I just heard stop on the low, and I was like, okay, that's what that is. and then I'm like, hang on, we're doing it again. What am I missing? But it's all good. I get it. Thank
Yeah,
you for
it probably
explaining.
would have been easier to test the ultimate stop at first, kind of. But I do normally do it like later stages to see like, okay, like what like ultimate stop can I have, and, and will it improve the results basically?
Is that to try and keep it dynamic because that's better?
Yes, just keep it as dynamic
Okay.
and breathable, so to speak, as you can. So the question is, will this improve our baseline? So let's find out. Let me see. I'm not going to do the complete in-sample test with the indexes. I'm going to do the whole basket because I'm going to want to do the whole basket out of the way. So everything looks good. This is exciting. We might improve our baseline. And if we get to 50 over 1, it's going to be pretty crazy, for being honest. But while this is running, I'm going to give me some more coffee. So I'll be right back, guys. Well, that thing is just taking its time, isn't it? Waiting for the moment of truth. So the question is, what if it doesn't improve our baseline? What does that mean? What is it trying to tell us if it doesn't improve our baseline?
Means that when there are price shocks, they come back. Or it doesn't happen enough to warrant a stop, or I don't know. I really can't think how it's anything.
Well, it's funny. It kind of made me think about price shocks a little differently, as an ever, once again, from Perry Kaufman. Perry Kaufman doesn't use stop losses. And someone was like, well, what about price shocks, you know? He was like, well, normally they happen so quickly that if that happens while I'm on lunch or something, usually it retraces and I still get out at a better price. And he's absolutely right. Almost every time a very hard volatile move occurs to the downside, you get like immediate bounce, essentially. And that's why one of the first strategy ideas I posted in the channel was based around price shocks. So basically it's answering a question here. Are we better off shielding ourselves against these price shocks, or are we better off, you know, waiting to see what happens after? Obviously Perry Kaufman doesn't give a shit about price shocks because he hardly uses much leverage or anything, and that's like the biggest concern, to have an ultimate stop if you are using a lot of leverage.
It's I guess it's just time as well, because it's like if you've got a massive move to the downside and it instantly retraces back to like where it started, that's one thing. But if you've in those situations, it hurts to have a hard stop. But it's the situations where it's just like, okay, we're just going to keep drifting down for the next 3 days kind of thing, and price is going to drop hundreds of points. Those and stay there. Those are the situations that are
Yeah, for sure.
gonna hurt.
Of course, that's on like a swing trade type idea, because we still have our actual stop, you know, which is the Laguerre crosses beneath the midline. So like that's why the only scenarios where it's going to touch our ultimate stop is if a price shock occurs. Because if it's just normal price action, then the Laguerre is going to get us out. But only in the scenarios where a giant price shock occurs will we exit by price touching the bottom and not by the Laguerre getting us out. So yeah, there's different ways you can think about it, why one might be better than the other. But now is the moment of truth. So let us see. Kind of anxious myself. Let me look at. It is a close call. Let me look at our current basket. Whew.
Last it was like 670,000, right?
No. Last time it was 723,000. Here it is 729,000. before the profit factor was 1.23. Here we're still at 1.23. Before the drawdown was $15,064. So the drawdown did increase by $600. So basically, you would think adding a hard stop would have a big impact on our drawdown. But since this condition only really affects outliers and anomalies, fundamental events, it's just not gonna cause much of a difference.
Is this kind of logic like a losing trade isn't a losing trade until you close it? I know, like, where a winning trade isn't a winning trade until you close the trade.
Yeah, I can definitely follow
Yeah.
along lines with that. And so drawdown up slightly, $600, but our profit increased by $6,000. So we have a 10-to-1 ratio on this improvement, basically. $6,000 increase in profit, $600 increase in drawdown. Our win rate dropped by 0.40%, so basically the same. Our average trade went up by 30 cents. Now let's look at our best performers. The drawdown, look at a drawdown. So our NQ, our drawdown went up on the NQ. Same on HO. Our drawdown went down. So very close call here. Seeing how it is a very close call and we don't know what type of anomalies might occur in the future, we can't base, we can't assume that, this is going to account for all the anomalies, basically. And so for that reason, we will be incorporating this because I just feel more comfortable anyways in almost all scenarios to have a nice ultimate stop. But let's look at the profit to drawdown ratio.
Even though this degrades some stuff by a really small amount, would you just run this because of situations like the Swiss franc getting depegged or the flash crash in 2010 or like crazy world event type things? Like,
yeah,
okay. Even if it's worse performance, like just as a full like failsafe.
Correct. And the fact that the average trade is a little bit higher because we have better performance. I didn't look at the products yet. Let me look at the losing products.
You make more money with less risk, even if you're seeing a little bit more drawdown. That seems like a pretty good trade-off.
Yeah, for sure. And since this is only to aid against anomalies, like we just don't know what type of insane crash might occur intraday.
Right. If Russia starts nuking Poland or something, hopefully your stop would get you out, but you don't want to wait for the Lagrange filter to catch up.
For sure. So let's look at the losers real quick compared to the previous losers. So coffee. So before coffee was profitable, now coffee is negative. But whereas before DX, the dollar futures was negative, now we're positive. So I guess we had some pretty serious price shocks on the index US dollar futures.
Those worse results is telling us that price shocks do occur in these markets. That's what it tells us, right?
Yes.
Okay.
Seeing as how what the only condition we added is for, you know, anomalies basically. Turns out the US dollar index futures, that happens more often, I guess. Which I don't ever trade the US dollar index futures, but it's part of our basket. And our worst performer now is minus 10,000, which is the Forex pair, the yen or something. Whereas before our worst performer was 8,000. Let's look at drawdowns. I think the highest drawdown previously on a product was heating oil. So heating oil had the biggest drawdown, which is 40,000. And let's see what the biggest drawdown is now. So RB is now 42,000. Oh, I made a mistake. Before, our biggest drawdown was RB as well, and it was 45,000. So our biggest drawdown overall decreased. So yeah, solid rule. It did drop our net profit to drawdown very slightly. It is 47 instead of 48. But great results, great rule, I believe. So let me screenshot this right quick. We have the new baseline. And obviously with our top performers for the indexes, the improvement is a little bit more significant. So, we explored a lot of different trade management options. And honestly, there are still a few more I have good ideas for. I don't think we're going to touch on that right now. Now we're going to move on to something else. Because what we just experimented there was what was supposed to be on yesterday's session, but we never got around to it. Now we can move to what today's session is supposed to be about. And it's down the rabbit hole. The premise behind adding adaptability to our strategy. And obviously it's not hard to understand what that means. So right now we have our rules set in stone for every opening range breakout. Mainly what I'm talking about is our targets, what gets us out, for a profit, and what our initial stop is, so on and so forth. And so what we want to see is if our strategy will benefit by, say, first, look at our stop loss. should our stop loss adapt to the current volatility? And what we're talking about is the initial stop loss. So if volatility is very high, would the Laguerre crossing the midline still be superior than the Laguerre crossing maybe the low line or the opening line? And same way with targets, should our ATR trailing stop and the multiple of such, should it adapt to whatever the volatility is? So how should we go about doing this? Because once again, it's just a yes or no question, you know. Gold says in B4 50 to 1.
Oh, that was like in before 51 to 1 when we were rolling the system to see if we could hit it. That was way before.
Oh shit, okay, I'm sorry.
No, we're still.
Just blanked out for a second. So let's see how we're gonna do this.
I got nothing on this. Like, I've got nothing to contribute here. I don't know.
Let's check this out. So let's pull up our chart again. And so we want to see if we should make our strategy adaptable to volatility. So the first thing we need is a volatility indicator. And now we can't use the ATR because the ATR is not normalized when it transits to other products. But what we do have is we have the NVI. Okay, the NVI is the normalized volatility indicator that is based off of the ATR. So we'll change it to 14 because that's the default ATR. And let's see what this looks like. We trade on the 4-minute charts. So let's pull up the 4 minutes and see what we are looking at. It's a much broader scope of things. But you can see here, volatility is low. Volatility increases. Volatility is really high. So on and so forth. Low volatility. And it's very unique insight. If you've never looked on like a broader scope of things to, you know, how the market moves in, you know, wave-like patterns. You know, what kind of is going up, low volatility, high volatility. Of course, these are mainly the market opens, or the, you know, the entire regular trading hours is pretty much giving us higher volatility. There can also be divergence when we're in a period where unusual volatility is high, but for some reason right now volatility is exceptionally low, and that's why normally people look at relative volatility to predict setups. But that's for predicting, you know, setups and occurrences, looking at relative volatility. Now we're just looking at, you know, maybe we should have different money management for the current, you know, real-time volatility right now. And so we can see that using this indicator, generally when we're above 0.2, that's a much higher, you know, volatile environment. So let's put a horizontal line that's 0.2. So basically we're saying here is whenever, you know, we're above 0.2, volatility is pretty damn high. And so we can look at the market open on this day. Looks like it is right here. And so you do see, we do get a big jump in volatility here at market open. And so you can even create an additional threshold, because this indicator is honestly very sensitive, depending on how we scale it. So you still see a massive jump in volatility once the market opens. Look at the previous, or the previous market open. Where are we at? So it's kind of right here. So that looks like it's 1 point. We'll add an additional line just at 1.15 or 0.15. Make this line red. We'll just do, yeah, where's the red line? So we have like really high volatility, then we have this normal high volatility, and anything below it. Let's go to the previous opening range, or the previous open. And you see that it's pretty much the same pattern each day for when the market opens. So it's from 8:30 to 9. By the time we hit 9, we were above the upper threshold. Right here, we got 8:30 to 9. We can also look at this on higher time frames.
Is it a problem if from 8:30 to 9 it's saying one thing, but then after 9 it's way higher? If you're trying to build something around, because the trade will take place 30 minutes after the open range. If it breaks out, oh, actually it might not. It might be a bit later, but if you the problem is if you set it and then it changes, like, are you gonna adapt for that, or is it just like, does it read whatever the reading is and then it sticks with that for the day kind of thing?
Well, that's, part of the potential idea that we're kind of working on.
Okay.
It's like volatility right now is above 0.15, so maybe the ATR should be 3.5 if our ATR trailing stop. Whereas if volatility is above 20%, well, it's actually, I think it's 200, I don't remember. But if it's above 0.2, then our ATR multiple should maybe be 4.5. And that can adapt in real time.
Jeez. But I can see how you can just go mental with this.
Yeah, you definitely can. So let's go ahead and run an initial test. So here, first we need to screenshot our initial basket. And so one thing to note is that these thresholds work fine against other products as long as you're on the same time frame. But if we moved up to like the 10-minute, which is a different time frame, then our thresholds need to be changed. So let's go ahead and screenshot our current mini basket. And so first we got to figure out what might be the better ATR value given certain periods of volatility. So in order to do that, we're not going to keep it as a parameter, but just to make things a little easier to having to come back in the builder, we'll just set a parameter for now. You'll see how we're going to do this. So we'll just do fall thresh. It needs to be a double, minimum 0.00. Go to conditions. Now we're going to go to the NVI. Apply it on the chart. Set the period to 14, greater than our threshold. NVI greater than our threshold. So now, right off the bat, this is acting like a filter. It's not what we want. It's not the purpose of this. So what this is going to do, whatever threshold it's set on, we're only going to see the trades that occur when that threshold, or when, when it's above, basically whenever that volatility is present. So we're only looking at the trades when that volatility is present, which is what we need to do if we're going to look at what might be the optimal ATR for that volatility. So we're going to go to optimization. So what we're going to do is do our initial, we're going to do 2 to 6 at 0.5. And we're going to start off by seeing what ATR value we get whenever volatility, let's do when it's greater. Well, first we'll do the extremes. We'll do the extremes. So we'll do probably 0.4 is going to be, because I'm looking at the chart, 0.4. If we're looking at the chart, so like 0.4, add an additional line. Zero 0.4 almost never occurs. Did right there, but you can see, look at the type of volatility that occurred when we were above 0.4. So whenever we encounter such a crazy environment like this again, that's what we're accounting for. Once again, a crazy market environment here. So yeah, so 0.4 looks like a good, like kind of outlier, maybe a little bit lower actually, because you see here the same type of environment. So we'll do 0.35 as our like extreme for the 4-minute chart. So 0.35, and I'm wondering what ATR value is going to be best in that type of market environment. Let's go ahead and run it. Should be set correctly. So it gave us 5.5. Is this at all surprising? No. Volatility is higher, meaning more noise, so we should have a larger stop loss. Pretty much simple as that. But we've just quantified it is all. So let me add to these notes and say, NVI is greater than 0.35. ATR 5.5. But so now, what if we're above, 2, but we're not above 3.5? So we're kind of like a mid-range of volatility, but still definitely high. So we're going to test, because basically normally we're always going to be looking at a range of volatility, but since first we're looking at outliers, there's only one comparison. It's just NVI is greater than just the greatest possible amount, basically, and then we get an ATR value. And so now we can test the opposite extreme, which is less than the threshold. So let's compile that. And then obviously as low as it can go is 0. So I'm looking at the chart, see what I consider to be an extremely low volatility environment. And it looks like basically under 0.05 is a very low volatility environment, which we'll actually very rarely see during market, like when the market is open. We're hardly ever going to see volatility that low. But nonetheless, when it is that low, in rare cases, I think our stop loss should account for such low volatility. 0.05, 0.05. So let's see. So yeah, it almost basically never occurred. And now that I think about it, since this is only going to take place during market, regular trading hours, we'll go ahead and increase our threshold to what might be normal, like really low volatility during regular trading hours. So let's look right here at market open. And it looks like, so normally it peaks off at around 0.2. .01. Get kind of a closer look here. .015. I think I like that. 0.015. That's 2 away from our other extreme. 0.05. But if I was trading a strategy, 24 hours a day, and I'm trading ETH, extremely important to look at the other extreme, which we identified to be 0.05, so that when volatility is super, super low, we are accounting for that. 0.15 and 0.15. So 2 to 6. Let us see what we're going to get. So it still gave us 5, surprisingly enough. But I made a freaking boo-boo. So I'm not aggregating the results. You see it's giving us the best parameter. Oh wait, no, maybe it is aggregated. Let me see. No, it's not aggregated. So yeah. We don't want the best results from each one. We want the most robust. And like I was telling y'all last night, maybe once we get to the deployment, we might adjust things slightly. So now we're on aggregate, maximum net profits. And let's run this again. Still gave us 5 for the best result. So I think this is a symptom due to the fact that all of our entries are kind of taking place at the same time. Whereas, once again, if you're running a strategy 24 hours a day, then the concept behind this is a lot more relevant. But now let's do NVI is less than 0.15. That to ATR gave us 5. And now we just have the in-between. So our extreme is 0.35. So we're going to set that as our volatility threshold over here on the inputs. I'm going to copy and paste. I'm going to say now it's less than our bottom threshold. Nope, doing that wrong. Greater than 0.15. Less than our other extreme. And we would just kind of classify this as normal volatility. So we get to set this to 0.35. So greater than 0.35, less, keep on getting that mixed up, less than 0.35, greater than 0.15. Let us see what the ATR gives us. And what do you know? It gave us our initial value, which isn't too surprising, because when the volatility is in the normal range, of course it can be only classified as normal if it happens most often. So obviously what happens most of the time is going to be what gives us our most robust parameter. So essentially now all we have is, potential adaptability for our trailing stop. For when we're in the money, so to speak. Didn't test our initial stop, but it's important to note. So this is our ATR value. So normally, you know, when the volatility is below our other thresholds, this should be a lot lower. Like maybe it should have chose like 2 or 2.5. It didn't. And like I said, I think that's just a symptom of how we're taking trades a lot at the same time period. But it might also be that it's actually indicating that when we're in the money and there's a period of very low volatility, and since we're in a time range when volatility is supposed to be high, the volatility being exceptionally low might indicate a squeeze is about to happen. And if that's the case, then yes, obviously, even though the volatility does get that low at random times and we're in the money, chances are it's going to continue to be very volatile, where it's still wanting us to keep our ATR value a lot higher to catch those bigger moves. So let me do, we'll just do the in-between here. So we'll just say like, it's just in between really. In between, it is our one we started out with, the 3.5. This makes a lot more sense to up here. So I actually might just remove the lower one, since this just doesn't really take place during regular trading hours. I might just say, okay, we're going to keep our stop at 3.5 ATR multiple, and then volatility gets really high, we adjust our stop slightly. But this is only when we're in the money, okay? So it's good insight. But what about our initial stop loss? You know, with the Laguerre crossing. I'm not going to test too many variations of that, but we are going to find out really quickly. So we'll test once again the extreme. So let's see. Greater than 3.5. So we're going to be doing the NVI is greater than 3.5. And our ATR value we got for that was 5.5. I don't want to switch back to backtest mode, but let's go ahead and will. Just move back to backtest mode. So this is when volatility is greater than 0.35. ATR is 5.5. And so right now as it stands, obviously, Laguerre crosses beneath the midline. So this is only when we enter our trade and the volatility is exceptionally high. Should we get, should we increase our lag basically? Let's run this test real quick. to get our baseline for, you know, this volatility and ATR threshold. Don't get many trades. Really need more sample size. So cross below. We're just going to test the opening range low. So we got 18,000 on 3. 17,000 on 4. So no, making it the low was no good. And just for good measure, let's put it cross below the high. Honestly, what would be a better measure is if we were just keeping it at the midline and slightly optimizing the period. So if it's the midline, you know, keep it like that, and then if volatility is exceptionally high, perhaps increase the period to where it increases the lag. I already know the high isn't going to give better results. Let's keep it at the midline and just double our Laguerre value and just see if we get better results. It was like 18,000 on 3. And results are better. We got 19,000 on 3. So might potentially add some more lag when volatility is higher. For now, let's look to incorporate the other rule and see if that improves our baseline results. And I just want to experiment with the higher volatility threshold first. So let's go to our ATR trailing stop. So here, P&L is greater than 0. We're at -1. So let me look into, I'm going to do this real quick. Greater than 0.35. So this exit condition basically we just got to add a threshold to both of our exit conditions. So here in the volatility, like if we're currently long, the volatility is greater than 0.35. Then we'll exit when the 5.5 ATR multiple equals -1. Whereas over here on our original one, we're just looking at anything below that extreme. So MVI is less than the threshold, which is 0.35. So in the money, and it's already at our, see this, we gotta change it to our 3.5. Or actually we'll just enter that in. So we'll keep it as the input. Very cool. In the money, when the 3.5 ATR changes to -1, if we are below the threshold, we'll exit. Over here, you know, if we are greater than the threshold, greater than 0.35, and the 5.5 ATR changes to 1, and of course we're in the money, we will exit. Now we can remove this little preliminary condition with the MVI. And we will compile. So let's go to our mini. So this needs to be set to 3.5. Our threshold is 0.35. Give me 1 second. Okay, let's go ahead and run this test real quick. 3.5, 4, and let's see what happens. Should be set up correctly. So let's see what we got here. There wasn't very many trades at all in that extreme volatility range, and I forgot to set something. No, I didn't. Yes, now we got, looks like 2 ATRs, but they only respond depending on the volatility. So not much of a difference on the profit because there weren't very many trades in that, you know, extreme volatility. However, let me pull up the current mini baskets. So let's see here. Overall performance seems to have dropped. Let's go ahead and see if this affects the overall basket, but I don't want to wait for the entire basket, but I need the baseline for the other one to even be able to compare. So we're gonna have to do the whole basket. So let's run the whole basket. I know I hate waiting too. But before I scratch that, you know, that change in the ATR multiple for the higher volatility, You gotta see how it affects, you know, over different environments and everything else that's going on. So let me save my workspace and run. So we're going to see this concept a lot more, and there's a lot of ways you can do this when it comes to trying to adapt your strategy. Another simple way that comes to mind with the opening range breakout is you already know that we're looking at the previous 1 hour bar, you know, for our filter. And so another potential way is to say, you know, is the opening range, pretend this is a 30-minute bar, or you can think it's an hour bar too if you want, but either one. But we can say that if the opening range, if both the high and the low is within the high and the low of the previous hour candle, so this would basically emulate an inside bar. So basically, you know, small relative range, a narrowing range compared to the previous bar, then adapt to that. Or of course, we can look at the opposite. Maybe the opening range is an outside bar compared to the hour bar. So yeah, it's a crazy opening range. And then we could adapt to that as well. And that's just one concept. A lot of different ways you can potentially adapt something to the environment. Of course, the most common way is volatility. Volatility and your stop losses. Because, you know, 3.5 may do best overall, but, you know, would this pattern benefit from tweaking the ATR depending on, you know, current volatility levels? And in most cases it will. But since this, you know, strategy is a lot more specific to when it trades, there's just not going to be a whole lot of difference in volatility. That's why I'm only testing the extreme, because, you know, maybe might benefit from having a wider stop essentially if the volatility is so high. But keep in mind, once that volatility is extremely high and basically the 5.5 ATR is activated, it's going to go back to using the 3.5 ATR the moment that volatility drops below the threshold. So it pinpoints specific periods in time where we get these massive volatility spikes. So it's like, whoa, let's, you know, widen our stop loss for just a moment so we don't get stopped out. And then once volatility calms back down, we're like, okay, let's, you know, put our stop loss back to our normal level. So I hope y'all understand the premise, you know, and the concept behind that. Of course, it can be used for any strategy. But will it affect our bottom line? That is the question. And see, you may be wondering, if we're looking at tweaking the ATR before deployment on individual assets and products, you know, how would we do it if the ATR is already adaptable to volatility? And you have to do more like a percentage-based approach, where simply if volatility is up 20%, then increase our stop loss by 20%. And so basically whatever ATR you choose, say using the 2 on, you know, oil, then the wider stop loss for increased volatility would just increase by, say, 20% when the volatility is beyond the extreme. That's the whole. Go ahead.
No, sorry. Go for it.
I was going to say that's
Is the whole. Sorry, it's a delay, man.
Yeah.
You go.
I was going to say, so we can look at this increase in stop as like a percentage, actually, like what percentage increases at 3.5 to 5.5, and whatever that percentage is, you would just translate to other products depending on what your starting ATR is. You know, if your starting ATR is, we could just do the absolute numbers if you wanted. So like 3.5 to 2.5 is or 3.5 to 5.5 is an additional, you know, 2 ATR multiples. So if we trade a different asset and our starting ATR is just 2, then volatility exceeds the threshold, then we just increase our multiple by 2. So it translates to other products. So what are we saying, Gold?
Just a quick question. I understand the optimizer thing that we used yesterday isn't a tool to try and get the most bang, like money out of the market. It's just it's like a robustness check, and to make sure it's not like it's to make sure there's a range for the ATR where we're in a sensible range and we're not just teetering over one edge, or we're in the ballpark basically. Yeah. How does this work with if you've got a dynamic ATR? Is it just dynamic within that range, or like
that's what I just described, actually. I guess I didn't describe it clearly enough. But it's like we look at it as
that's probably me.
Think of it like this. So the way it would translate to other products is you go by the starting ATR. So for example, here our starting ATR is 3.5. When volatility exceeds our threshold, we increase our ATR by 2 multiples, which is 5, which is 5.5. So that's all we need to basically know, is how much do we increase our ATR multiple whenever volatility increases our threshold. And it all depends on your starting ATR. So maybe we choose our starting ATR as 2 on EMD, and now when EMD crosses a threshold, we'll increase the ATR multiple by 2, and it'll be 4. That's how it'll translate to other products. Of course, you still need a way to figure out what you want to be your starting ATR, which is what we were doing last night, looking at those optimization graphs.
So how do you filter high volatility? Do you filter trade results by have to go full big brain here to try and get this and to keep up. Do you have to filter the trades that were only taken in high volatility?
Yes.
To then be able to see the optimization curve thing?
Yeah, but we wouldn't do that to get our multiple. Just need like a general, because really there's not a whole lot to overthink when it comes to, increasing our multiple. I mean, it's kind of common sense. Like we didn't.
Okay, because it's already like it makes sense. It's just more of what makes sense, kind of thing.
Yeah, like it's not rocket science to think, well, maybe I should increase my stop in periods of super high volatility. And we just ran some...
Yeah, totally.
Yeah. We just kind of ran some initial tests to kind of get that increase in multiple, and also get some validation, because we ran it to where only the trades that were like exited at super high volatility, and we got 5.5. So it just kind of validates that that idea that we should have a wider stop to extract the most amount of profit in scenarios when the volatility is super high. And like I was saying, if the volatility, like in real time, if that volatility drops below our threshold, then our stop loss gets to a more, it tightens up, essentially.
Okay.
So let's see.
I get the premise and everything. I think I'm just trying to like work out the specifics, but this is like this is a different way of thinking, I think.
Yeah.
I just haven't really I haven't had to think in this way, like systems wise before, like how can we measure this by doing this and multiplying this and stuff. Like I've never really had to thought about that. So it's just all new.
That's why I said it's down the rabbit hole.
It's
How
fully down.
how can we add adaptability to our strategies? And it is it's kind of a interesting concept. So let's look at our results right off the bat. I see we have additional unprofitable products. Not sure about how many. And then boom, here's the results. It didn't improve our overall results. So I guess what's that telling us is that when volatility gets really high, we're still better off keeping that initial stop, because let's look at why we want to increase our stop. So let's say price is kind of just moving on, nice beautiful uptrend, and then out of nowhere we get this type of price action. When this occurs, that's whenever our stop widens, but the drawback of this, we have to use a second. We basically have two ATRs, so this would be like our tighter. It's a terrible indication, but it'd kind of be like this. Whereas our wider ATR, because it's always there, it's just whether or not if it's activated. Our wider ATR is like this. So let's look at the drawback of something like this. Let's say it hits it there. It's all, like anything else, dependent on what happens more often. Meaning, when volatility increases, now we're not using this ATR anymore, we're using this ATR. What we're essentially saying is like, well, let's widen our stop so that we don't get faked out in case price, goes back up and keeps on going up. In which case, we saved ourselves and we're catching a fat tail. But this has to happen more often than this, where we increase our stop, but the increase in volatility ends up leading to a reversal and stopping us out. In which cases, since this is happening more often, when it comes to the bottom line, we're just taking bigger losses versus using a 3.5. So that's the potential drawback. And it's worth seeing more sample size, but we'll just go ahead and lay off the adapting to the ATR, or adapting to the overall volatility. But like I said, with other patterns, especially if you're trading 24 hours a day, then adapting to the current volatility can be very valuable, because I've been very successful with it with a lot of previous systems. But that just means we get to take away. And I love taking away shit. So let's take away this set. Our exit long. And make sure I don't miss anything. And let's take away this threshold requirement. let me go ahead and compile. It should be back to our baseline. Let me make sure. Get rid of the volatility threshold. Compile. And let's go ahead and run this. Make sure we're back to our baseline. No shit. No, I didn't mess up. Okay. I thought I ran it on the whole basket. It'll be here forever, but no, it's on the right one. Back to our baseline. Beautiful. And so it's really important for me to cover the topic of adaptability, because what we just illustrated there is just one way to potentially allow this strategy to adapt to current market conditions. And it doesn't have to be the normalized volatility indicator. It doesn't have to be our stop loss. It could be our target. It could be maybe we should wait a little bit longer to enter a trade given certain conditions. Like, there's just literally endless ways to potentially adapt your strategy. And I, of course, highly encourage people to seek new ways to potentially adapt the strategy, as long as it, makes perfect sense and you have a solid premise to why that might be, a good reason to adapt. So cool. Once we start streaming again, we're going to maybe look at one more money management, trade management method, or perhaps over the week y'all get some ideas that might be worth testing out before we get into more robustness / expectation tests. I like to call them expectation tests because our current basket and core basket is fantastic, but we can't expect these results moving forward. So we have various tests to gauge our expectations and what we can actually expect out of the strategy, what type of variance we might be looking at. Might do some noise tests, some variance tests, just to see, what can we potentially expect. Just how robust is this, is this strategy. So just for fun, so I did this yesterday. I don't think I did it live. But so, just a quick out of sample test for the indexes. We got the start of the year to today. And so this is completely out of sample data. Like, nothing was built on this data. Nothing, completely new. So we could just pretend that we finished building this strategy at the end of 2022 and started it this year and see what's going on, right? So let's go ahead and run it. And very nice. So the indexes, like I said, this is a good strategy for the indexes. We're profitable on all the indexes. We're up 64 grand this year so far. Our net profit to drawdown, is almost 10, but we're not really getting, the diversification here. So this, just running it on the indexes without any diversification or anything. So
Just a quick question on this one. Like, on this test, you just literally like 30 seconds before you're like, just for fun, let's try this. You were talking about expectations, and I can't remember the other things. It was expectations though. Like, you're never going to make as much as what a back test says, basically. Like, would, if you had run this, like if you had just stuck this in a brokerage account and been like, right, let's go on the first, would this have been what you would have made, or is this still like back test only kind of territory?
well, technically, this is what we would have made. Granted, maybe a little bit of slippage.
Okay.
But what we can look at is our average trade, which, let's see, is $359. But that's subject to sample size. Whereas, on our core basket, when we had just, 12,000 trades, our average trade is $50. And so you're going to see those like volatile fluctuations in the metrics depending on sample size. But yeah, you have to run it for quite a while to get a sample size that you could actually compare with.
It's like poker, like you've still got variance like over time just because variance exists, sort of thing. Like you need to do tons and tons and tons of hands to bring it back to like expectations, and even then you still got variance. Like,
exactly. Typically with strategies, we'll look at the average monthly P&L, and that gives us a good metric to, just kind of, the average monthly P&L is 10 grand, then as long as that average stays pretty consistent, you could look like, you could look at a line chart of the averages. So if like the average, we get like a scatter plot of the P&Ls each month, let's say anything below this line is negative, anything above it, no, I say line. But it kind of looks like that, given the P&L of each month. And so if you start running it live and this line starts going down, then something's wrong. You might want to look into managing that strategy a different way and go from there. But that's, once again, this falls in line with portfolio management. But I think moving forward, definitely see if the monthly P&L, like actual like dollar amount, because the dollar amount works fine for this. See if the the monthly P&Ls are falling within the expected variance, basically. Whatever the standard deviation is. So, but yeah, this is great results for the year so far. But this could have easily been negative 64,000, and it wouldn't mean shit. The P&L wouldn't mean shit. But definitely looking at the variance of the monthly values give us some insight. But we only got 1 month, so 1 month isn't enough. You just gotta wait. Really, you just gotta wait. Just gotta play the waiting game. These things don't happen quickly. You get reliable results. Let's see. You could add some slippage to it. Let's just add like some crazy slippage. Let's do 10.
The thing about slippage, it's really confusing. Why? Because slippage is not all the time negative. It can be positive too. So I think that the positive slippage will cancel the negative slippage, and then a backtest without slippage is as good as a backtest with slippage. Like, what do you think?
Well, you can see here we're doing slippage by like 10 points. It looks like. Make sure it's 10 points. 26, 26, 26. I'm not exactly sure how it's calculating this slippage, but with this amount of slippage, we're still profitable, which is just a good sign. And you can also, like I was telling you, you can optimize with slippage, so it's almost like a noise optimization. But normally you don't have to worry about slippage in most cases. Slippage is like killing the edge, basically. Because, for example, if you were to flip a coin and you got paid like 1-to-1 on every outcome, then save. So like you got paid 1-to-1 on every outcome, and so there would be like periods of time and like when you're up some or when you're down some, but over a large enough, say this is like the mean, since you're getting paid 1-to-1 on a 50% chance, eventually all of these would fall into the mean, and it's over, no matter what sample size, 1 billion outcomes, it will still end up at the mean, which is 0 for a coin flip 1-to-1. Whereas, so if you have that mathematical model, and now you just say, well, whenever it's heads, I'll gain 1 plus any amount, literally. Like, maybe you get paid $1 for every time it hits heads, but now you're getting paid $1.10 for every time it hits heads. Now, over 1 billion outcomes, it's going to gradually go in your favor, and that's what an edge is. And that's why casinos have an edge. Because the games they play, the rules are set in stone. So the edge is concrete, it never fails. That's why the house edge is extremely small for some of the games. But they know that any amount of variance the player might have, the player might be up at one point, but they know it's going to come back down because they don't have an edge. Whereas long term, the house will steadily gain profit. It'll be very linear and a real good Sharpe ratio, But we can't achieve this with trading. So I was telling y'all, a true edge does not exist with trading. It is a fantasy. There is only what has worked and what is currently working. There is no true edge because the rules are not set in stone.
Question, please.
Yeah.
So, there is no edge in trading. There is what has worked and what is working. So, and what is working is the pattern that at some point were working in the past. So mainly what is not working today is the pattern that are not occurring enough.
Correct.
Uh,
That's
well,
the only logical way to think about it. And now, obviously, if you get deep into quantitative analysis and quant trading, like someone asked, like, do you think you could get an edge there? I still think 100% no. Because overfitting is impossible to overcome. And whatever whatever forecasting model you're able to create, is still always built on historical data. And since the rules aren't set in stone, literally anything could stop working the next day. Does not matter what you are using. That is
Just
why,
because it's not occurring.
say it again,
Just because it's not occurring enough.
correct. It's not happening enough. And that's why
No.
the premise behind using fat tails works so well. Because
What I'm asking you, man, is like imagine if a signal, like an entry, is not is occurring. Like you backtested the idea, you have a big sample size, the idea is working, and once you start getting live, you started losing money. So to you, your explanation to this is because the trigger is not occurring enough. That's your explanation to this. I just want to know, is it really the case, or you think also that a system can just stop working out of the blue?
well, it depends on two things. One is your system overfit. Now, if it's overfit, then you have two potential issues. And that's
No,
why
it's not over.
I say your system has to be simple and robust. You have to
So,
know, you have to create it.
so let's say it's robust. It's good. It's like all the validation
Yes.
tests are check.
If it is simple and robust, then it's only because the pattern is not occurring.
Okay,
That is it.
got you.
That's why I say it's easier just to wake up each day, and if you have built a strategy that is designed to exploit an opening range breakout, all you gotta do is wake up and see if an opening range breakout is going to occur or not. If it doesn't, you're not making any money, and we have conditions set in place to attempt to mitigate risk. If it does occur, well, now we got conditions set in place to further exploit that pattern. As simple as that. There is no, oh, well, what's the edge? Like how much of an edge? It doesn't exist. It just doesn't. It's just, is the pattern going to occur or not? This is what we're going to do if it happens. As simple as that.
Yeah, it's just amazing to know that if after doing all the tests, if we are not going to make money, it's simply because something is not occurring. That's very new to me, man. Thank you.
Yeah, for sure. And like I said, that's only prevalent if you're not overfitting or using too much filtering. And that's why I said with the filtering, which we're probably going to end up not even using this filter. But now we're susceptible to an opening range breakout occurring and us not being in the trade. And that's like a big no-no, That's why I just say, trade management is better than trade filtering. That way, whenever we get an entry and things don't go our way, then we have a way to manage our trade. But
Yes.
let us now, where was I at with this? So let me change the back to the mini basket time frame. And so another topic is once we start looking to create like complementary strategies, like let's say opening range breakout does terrible in 2021. Well, we can look at what type of market environment it was, and what is happening a lot more often in 2021. And what type of pattern is occurring. And we can make, a system based off of that pattern, essentially. So let's say we have our 21 to, well, we already did 21, so I'm talking about 2020. Let's say it does terrible in 2020, it's not profitable overall, and then we create a system that does great in 2020. Well, that indicates that this exploits a completely different pattern that could potentially be complementary to the opening range breakout. So that's kind of the first a first leading indicator that you might have some complementary strategies. If you look at like a 3-month time frame with opening range breakout just did terrible, then you make a strategy. And what I'm talking about here is completely reliant on you not overfitting. It still has to be simple as can possibly be, still has to be robust, and if that is the case, and then you exploiting a pattern that did great in the months where the opening range breakout did terrible, then you're on the right path. Two thumbs up. But now you have to compare to how that strategy does whenever the opening range breakout does really good. Is it break even? If it's break even, that's great, because then our portfolio curve is still stable. Kind of like how I gave that soybean comparison, where a guy's been running the strategy for like 5 years. It's been a break-even strategy, but it's made his portfolio great. And so that's what we want to look at. So does it do kind of break-even, or is it still profitable overall, even when the orb is doing really well, or is it just losing its ass? Just losing a shit ton of money, in which case it's actually not a very good complementary strategy to the orb, because it's going to be drawing our portfolio down too much, or just keeping our portfolio at break even. If you have the orb doing really well and we have our other strategy doing really bad, then portfolio is just going to kind of stay where it's at. Whereas what we want to see is whenever the orb does really bad, the other strategy does really good, and then maybe when the orb does really good, our other strategy is at break even. And that's why you have to build onto your core system.
Do you still test this in Ninja Trader? Like, how does it work? Do you just copy and paste everything into one strategy, or is there an option to run 2 strategies at one time, or like, how does it work?
Well, I mean, it definitely wouldn't all be the same strategy. These would be separate strategies. To do portfolio analysis, I'm going to have to hop on over to Excel to look at more, the combining of strategies and different types of visuals, all that good stuff. Whereas some other softwares actually have portfolio analysis, like multi-charts and TradeStation. Unfortunately, NinjaTrader does not have portfolio analysis tools, so we got to hop on over to Excel. And I'm still constantly trying to find like a good. I do have one. I have this other like proprietary software that we might use that instead for our portfolio analysis. But we'll get to that whenever we get to it. But to keep things as simple as possible, because I would like you guys just to be able to have NinjaTrader, just have one account, and say maybe we can create a complementary strategy to the orb that only trades like crude oil. So that way it's a completely different product, and you have a strategy that's complementary to the orb, and you can easily just run both of those at the same time. Have this strategy on the ES, NQ, have this strategy on heating oil and crude oil, and they complement each other's. Now, if you wanted to run, say, 2 separate strategies on the same product, then you have to have multiple accounts, or else, because the way NinjaTrader does it is like, it just looks at your total position. If you have 2 strategies on the same account, it would just If you have two strategies on the same chart in the same account, it would just look at your total position. So it would say, like maybe your first strategy enters long, then your other strategy enters long. It would just say, okay, you're long 2 contracts. That's all it would see. And then, especially if you're looking to hedge, then it just wouldn't even work. You have to
So
have,
how do you run it in the real world? Like if you've got one strategy that's saying be long corn, and then you've got another strategy that is saying go short corn, like how does that work?
that's what I was saying. You just have to have multiple accounts in that case,
Okay.
and it's not that difficult. You just have multiple accounts. It's like MetaTrader makes it super easy to have multiple accounts. You just add a sub account, boom, you're done. But so yeah, I would like for y'all not have to do that. I would like for y'all to
I
not
don't.
have to do that first, because so if we just have like complementary strategies that are on different products, then you don't have to worry about having a separate account. And also, since there's so much correlation with the indexes, you could actually get hedging capabilities due to the correlation. But for example, the NQ moves a lot more than the ES, and maybe take like 2 contracts on the ES, one contract on the NQ, and then have like short mean reversion type concepts on one of them, and it's still going to achieve the same result for the most part since they're so correlated.
I feel so. There is 2 things that I didn't understand. The first thing is why you told the goal that we will maybe need 2 accounts. Second one is second question is about complementary strategies. Uh, the fact that there is some strategies that will not perform well with others, I really don't understand how it's possible, because once a strategy is good enough, well, I don't see how. Like, so is it a correlation thing?
So let me make an illustration that you might have missed on a different session. And so we're looking at just individual equity curves of our strategies. So let's say this is the equity curve of our orb strategy right now. Okay. We have a different strategy that has an equity curve more or less break even, like this. When you combine these equity curves, your portfolio curve will still pretty much look how the orb looks. This won't be as volatile as the orb. So you get a more stable, very steady growth on the equity curve. Now, let's say the orb starts to fall off really hard. It's doing terrible, right? It's kind of doing this over here, then eventually it recovers. If we were only running orb in our portfolio curve, we'd do the same thing. It would just do terrible. And that's not what we want. This isn't a big deal for individual strategy. It is a big deal for overall portfolio. Investors see this and they're like, we need to jump ship. Something is wrong. So let's say our complementary strategy does good whenever the orb does bad. So it kind of does this, and then it starts to fall back down once the orb starts doing good again. It kind of gets back to like a little break-even phase, but maybe now it's a little bit greater than it was over here. So maybe it comes back down. It kind of starts to level out again. So it's kind of like over here. Now on our portfolio curve, these pretty much cancel each other out. And the results on the portfolio curve is what you would call stabilization. So now your equity curve is kind of just hanging out. Volatility is low. It's what investors like to see. But then once this occurs again, orb starts doing good, this strategy goes back to a more break-even phase. But now we're starting to creep back up again. And now we're doing good. That's the concept.
I see what you mean. I see what you mean. So I completely understand your point.
Cool.
It's very valid.
So now we see the
It's
point of running multiple strategies and how it decreases our drawdown, because that's why our drawdown is so low on our that's not our core basket.
But at the same time, I understood that two complementary strategies need to be uncorrelated. But yeah,
Yeah, I mean,
completely uncorrelation.
exactly, because that's when it has the greatest
So,
effect.
but when the one who is making money, the other one is like not is losing money, but not as much as the other one is making money. So which will make a steady
Correct.
push it.
That's why I kind of said, now if you make a strategy that's complementary and is like very profitable overall,
So
I mean, then the results are even better, basically. Like, let's say orb just sucks really bad right here and it ends up doing good, whereas you have a second strategy that is just as powerful as the orb, but when it draws down, it like even has like a greater spike in profit. Then that's like really good too. Then it's still leveling out that whole curve, and giving us a real good portfolio curve.
I see. Well,
But honestly, the break-even scenario is better if it does like break-even, then has like spikes and really good performance. Because even in this scenario, these two equity curves, you're going to see kind of a decent little dip in the equity. But it depends on how volatile this performance is on the second equity curve. Like, how much profit does it make whenever the orb's falling off? But yeah, some cool concepts. And like I said, wanted to introduce y'all to adaptability before we wrap up this week. Is now you pretty much it's very possible for you to understand nearly the entire approach to creating these strategies now. And
yeah,
you
man, I
draw.
just need one.
Go ahead.
I just need one thing. Is the fast review of all the inputs of the strategy at the end of the video.
Yeah,
Just
yeah,
know, because
for sure. We do
because,
that.
I swear I will spend tomorrow like working on. I need to get the baseline that we are at like right now, so that I can start following and doing exact. Because right now, if I watch a video, I don't understand exactly what's happening because I don't have the strategy. So I think that having the strategy is going to allow me to learn faster.
I'm gonna go ahead and go over them in a second. One second. All right, let us go over the conditions. I'm kind of concerned with the lack of people on this stream today because I know it's a good time for most people in other time zones. I assume it's because most people are just really far behind and feel like if they're watching this, they're like, I guess, not getting much from it. That can be the only reason. One I can think of.
Well, there is another thing. I think that they just can't watch the whole thing, and when they don't watch the whole video, they um, think they will never catch up.
Yeah, definitely a possibility there. So let us go over the conditions. So right now what we're looking at, obviously you don't get much information from looking at that. So I'm going to pull up each individual one to where you can pause the video and clearly see every condition. So I'm going to go through them pretty quickly. So set 1, price close, cross above, opening range, high. We have the super trends. Set the baseline to 14. Baseline smoothing, HMA, offset formula, range. Make sure all these look how it looks on here. Trend value plot equals +1. We have a time of day filter. Time series greater than 9 a.m. This is 30 minutes after the market opens. It might be different for you. Other one, time series is less than 4 p.m. Strategy current market position equals flat. And our filter is price close. Go to series 1, data, primary, 60-minute. So price close of the 60-minute bar is less than the EMA on the current chart. Set the parameter as filter period. The way we get access to this 60-minute bar is by going to additional data, clicking on add, checking primary instrument, keep it as minute, put 60, okay, and that's going to add the 60-minute chart as a selectable input. Back to our conditions. All of this occurs. We have our enter long position, quantity, type in 2. On to our next set.
Sorry, Akotic, please. So,
Well, hold up. So I'm gonna keep all this nice and smooth. So if you didn't catch anything, you can just rewatch the video and pause it wherever you kind of got the hiccup at. Is that okay?
yeah, of course.
Because that's why I'm opening everything. That way you can just pause it wherever to make sure it's identical on your screen. So let's do the next set. We have unrealized P&L is greater than 0. And then we have our super trend, same settings as last time, but now trend equals -1. We're going to have exit long position, position quantity. We have to hit set, strategy, current position size. Onto our set 3. We have the adaptive Laguerre filter set to 3. Cross below the opening range midline. In the action, exit long position, once again, strategy, current position size. In our fourth set, we have position, current market position equals long. Current position size equals 2. Bars since entry greater than 10. And unrealized P&L is less than 0. Scale out variable is true. To get this variable, we gotta go over to variables, click add. You would type in scale out, set it to a Boolean, and by default it's gonna be false. Then you get that scale out variable. So over in conditions, when all that occurs, we go to add, Scale out equals true, so you would check mark that, and it would pop up like that. Set number 5, we have scale out equals true, so the user variables, scale out equals true. Position quantity, current position size equals 2. Now we have another variable, which we called entry price. So you would add, type in entry price, do double, leave the value at default. So when these things occur, we do entry price. We would set the entry price to our current position or our average position price. And that's how you'd get that. And then we set another one where we exit long position by a limit order, and set the limit price as our entry price. On to set 6, we have current market position equals flat, scale out equals false, add money equals false. Just uncheck to get that false value. On set number 7, we're setting another variable. So current market position equals long, current position size equals 2, bar since entry is greater than 10, unrealized P&L is greater than 0. Set the add money variable to true, but you should know how to make the variable. Just go back over here and make it the same way you made the scale out. Set number 8, add money equals true. Now we have the minimum low. So you set it to the low, price type low. Set the period to 10, so the 10 period low is less than the 10 period low than the previous bar, as you can see here. So price makes a new 10 period low. And also the 10 period low needs to be greater than the opening range high. When that occurs, we enter long 1. Set number 9, our final set. Position quantity equals long, or my bad, current market position equals long. We're setting our ultimate stop, which is a variable we called stop price. So in the variables, stop price, make it a double, default 1. We set the stop price to the opening range low. And now, one more action. We exit long position by a stop order, position set to the total position size, and then stop price is the variable that we named stop price. So cool. You should know how to create it based off of that. I'm going to go ahead and end the video quickly so people won't get it mixed up. I wanted this to be at the actual end of the video. So I hope y'all have a good one, and I will be back on stream probably end of next week and continue on with the orb.
End of next week.